It's a little risk disclosure. Something well, it's important to know that trading is risky because I know some of you, our emails can kind of get bogged down with how easy things are. And it does seem to not be as easy as emails say, right? Anyway, I just find that funny. So I love this slide, and I just wanted to share it with you. Navigating in a surreal environment. Peter Pan's taking the little boy to a magical never land that is unaffected by events in the real world. And the little boy says, well, we're going to Wall Street. So, I mean, if you can think about it for a moment, a surreal world. Besides going back since October when we had the Cubs win, and in November, the Cubs win the World Series, not to mention the election. And, of course, the Blackhawks just lost 3 in a row to Nashville Predators. That's pretty much a surreal environment. Caterpillar gets raided by the FBI and for possible accounting issues, and the stock doesn't even move. There's just been a surreal environment, I must say. The first 100 days of President Trump's administration, or I don't even think all his cabinet's been elected, or have been sworn in. Let's put it that way. So it's been a different year, to say the least. A lot of seasonalities aren't working, and we're going to cover some of that. And I think what we've been seeing is a lot of problems that traders have faced is either over-trading or under-trading, frequency or overweight market sectors, or financially leveraged, excessively leveraged. Options. I know there's a lot of option traders in the room, and I see you all here. Gentle John, I know. I see Andy and Alan and David. Who else we got? Oh my God, geez, look who we attracted tonight. Welcome everybody. George, of course, Volley. Sorry to throw last names out there, but the thing about options, and we do options in our trading community every day, or look to do that. And out of earnings season, which I think a lot of people look at all the possibilities, then you get down to looking at an option strategy and you find out bid and asks are about a mile wide, or what I like to look at, I like to see options within 5% valuation between the bid and the ask, and we're seeing options between, I don't know, it's crazy numbers, 20%, 30%. So not all trades can be done with liquidity or decent liquidity in options strategy. We did a quick one on Netflix, which the implied volatility was so high, for me it was a no-brainer. It was an option writing strategy. We thought it would be contained within our expected move, and so an iron condor is what we recommended, and that was in the trading room. And it was really literally an overnight trade. And a lot of stuff, when we look at today's earnings with, or what came out for Goldman Sachs, I have a kind of an interesting concept that we're going to talk about. And I want to share this with you first and foremost. This is something that I write up every week, and I want you to look at the date it was created. So it was created on the 10th. It was finished on 3/12, right? This is the weekly thoughts and observations that we put out, and I'm just going to cut to the chase and scroll down a couple things here. I always go back to this and talk about the blasphemy, because I said, well, anything can happen in this crazy. I'm hesitant in sharing this, but my duty to provide you with analysis. Some may find this a bit like blasphemy, but Goldman Sachs looks toppy. Weekly volume momentum studies indicated with bearish divergence patterns. And they all formed these weekly low-close dojis. So if we go back in time, and I just wanted to bring that to your attention, because what we're going to share with you tonight is, and I pop this up, here's Goldman Sachs, and on that day on 3/7, and then that week on 3/12, and then you come into the weekly chart, one of the things that we have, and we're going to discuss tonight, is this little tool here that we created. It's not available to the general public. It's called the Person's Market Catcher. It is a relative strength tool, and I'm going to describe this in just a little bit. But at this point in time, everybody was looking as if well, not everybody, but a lot of people were thinking that this trend was still good, and that Goldman Sachs would be moving sharply higher, and that the bank stocks were looking still prominently strong at that time. But when we were making a newer high in Goldman Sachs relative to its first high, primary high, secondary high, the relative strength indicator was warning or showing a bearish divergence. So I know when I say that there's certain tools out there that we could utilize, there are certain things that are kind of working in this environment that are helpful. And that's one of the things that I think is kind of important that we all at least pay a little attention to. And I think this is the key that we face is execution's a big word. Execution has to do with getting into the trade, getting out of the trade, liquidity, market knowledge. And I think some traders do not possess, I guess, not all of us do, I don't at least, have insider trading information. It would make our job a lot easier, but may land us in jail, so we can't really use insider trading. And a lot of people have certain things that they use, like unusual volume activity, and that's normally not something I've used in the past. I don't look for unusual volume activity in an option and then go trade it. I look for my own analysis and then apply a strategy. And I think the solution that traders and what we need to have in this market environment is a little bit better market analytical skills. Understanding some of the differences in these derivative markets like options and applying maybe more option strategies or not. There were, and I think in this environment since last January, my explanation of the, and I think some of you may agree to this statement, we seem to have a little less liquidity in options than we did a year ago, and I think maybe we see while implied volatilities on individual stocks has increased at times, the overall implied volatility has decreased overall. Case in point is the volatility index, the VIX. I mean, we just have had a slow grind lower in the equities off their highs, most of the indexes, and in fact, as of Friday, many of you may not be aware of this, but you know, the Russell was actually negative on the year, was negative. The Russell 2000 small cap, as much as the headlines say the stock market's doing great, the Russell was actually negative on the year as of Friday's close. What does that have to do with what we were trading? A lot, because in this environment, we are seeing a seismic shift in how institutions trade, what they trade, and the availability of being able to move money around in certain stocks, equities, inverse leveraged ETFs, and products to use to hedge. It's no longer just an option on the spiders to hedge a position or gold or bonds. It's VIX products. It's volatility products, SVXY, VXX. We have leveraged volatility products. We have leveraged inverse leveraged products. So there's a lot that we could utilize, and I think this is a day and age where I am seeing, and I'm sure you would agree to this, a lot more computer algorithmic programming, and it is here. It's not going away. If anything, it's becoming more prominent in our trading community. I think if you have a trading system, whether that's long stocks, short calls, and they can be ratio and timed. So let me describe different trading systems. What I mean by long stocks, short calls, if you had a trading system where you had dividend yield blue chip stocks, where you're long the stock, collecting the dividend, you can sell out of the money calls. They could be ratio. What do I mean by that? You could sell 50% of the position is shorting calls. That way, in case the stock soars to the upside, you didn't get called out of all your position. And you can also time those short calls to around earnings or directly right after earnings. So you can kind of time your strategy and your ratio. You don't have to be always selling premium against a long stock, and therefore that's a pretty decent high maintenance trading system. We have trading systems where we look for breakouts, momentum, and you could filter those trading systems with the time of day or the week. Like I'm not going to start trading the system, automatic system, on Sunday nights, and I'm certainly not going to take trades after 3 p.m. Eastern time, Friday afternoons. Time of day. Well, if you're a day trading system, you could certainly trade it if you're trading futures, right? You could trade overnight. A lot of things that we've been talking about for years is, and yesterday was no different. 3 o'clock in the morning, Eastern Standard Time, you find smoother moves in some of the markets, specifically the E-mini S&Ps, more times than not. In the European session market, smoother, meaning less volatility. Now, I just changed the screen, and I'd like to share that with you. And if I do, I'm afraid I'm going to, I thought that would happen, lose the, and I'll try this again. I don't know why that's doing that to me, but it is doing that. What I was going to share with you, let me get this up and see if it can happen. I'm going to change the symbol to E-mini S&Ps, and I'm going to just go over here to a 15-minute chart, and I'm going to show you from a day trading perspective. Here's a much smoother, of course, we come into the market, nothing happens, a sell signal. That's a PPS sell signal. If you have Thinkorswim, many of you are aware of this. This is my indicator. It paints a arrow on the screen, on your chart. It paints bullish and bearish momentum indicators. So it tells us, it gives us directional guides to the new turn or trend of the market. So if you're new and never seen my indicators before, this is what we refer to the PPS, Person's Pivot Study. It's called PPS, and it's available for anyone to use on Thinkorswim free of charge. What I'm showing you right now, if we go down the screen, right after 3 a.m., this was a pretty smooth, defined trend. Now, we come into the market at 9:30, and this is pretty much not a smooth trend in the market. More times than not, we get that smoother trend. Why is that? One of the reasons I believe that is we have less computerized algorithmic trading at this time in the morning, and it's reserved, and many of us, like myself, are not awake at trading that as much as I would like. So when I make the comment about looking at trading systems, and when I say we need to filter out or use time of day or week, that's the filter that I'm talking about. When do you turn on a system? And are you just looking at a system of just E-mini S&Ps? Now, I'm going to say this again, because if you have a trading system in this world, are you just trading E-mini S&Ps? Because correlations is a very important word, relative strength is a very important word, and this seasonality is very important. Now, there isn't a trading system that we could also improve upon by use of volume and volume studies. Many of you know I've helped popularize this tool called On Balance Volume, which helps to define trend of volume. So when we look at trading systems, this is a big topic right here, trading systems. This is a huge topic. You have stocks, you have breakouts, you have filters you can use, you have additional indicators such as volume. You can look at correlation systems, and you have relative strength systems and systems that you can incorporate seasonality. So we're going to talk about these topics tonight and cover these quickly. So in our toolbox, and I mean there are a bazillion and one, not a million, a bazillion and one technical tools. We have different, maybe not, that might be over exaggerating, I'm sorry. We have charts, we have bar, candle, point and figure, Renko. I mean, now there are so many different charts now, I can't even keep up with them. Seasonal analysis is something that, since I was the co-author and creator of the Commodity Traders Almanac, I'm quite familiar with seasonal analysis. And all types of indicators. Relative strength, we've got oscillators, moving averages, CCI, my favorite, my mentor, who I worked for a couple years. Many of you use his indicator, stochastics, the guy that created it, Mr. George Lane. I worked for him for a couple years back in the early 80s, and it's where I got my introduction to technical analysis. And then there's volume. There's been a problem with volume, and I mentioned the one problem with volume is it gets diluted. We no longer trade an individual product. In other words, we don't have to just trade IBM. We could sell a put, buy a call. We're in a synthetic long. It has the same corresponding change as the underlying, and so therefore, if you do an option strategy rather than buying the stock, guess what? That trade that you've done, that volume is not reflected in the underlying position. So therefore, volume histogram trends has been something that's been kind of not working as efficiently as it once used to. That's where the tool that I've been using for a number of decades, on balance volume, that was Joe Granville's tool, is one of the tools that I use to help detect and determine the volume trend. So it is a very useful tool, and I'm sure some of you have picked up on that through the years. And breadth analysis. When I talk about breadth analysis, I'm talking about advanced decline comparative ratio lines, advances versus decliners in stocks. We have in our toolbox fundamental analysis even, price to earnings ratio or price to earnings or growth rate, PEG. So there's all different ways that we can look and different tools in our toolbox. What we want to discover is what's the most effective one and what do tools give us. And tonight's presentation is basically to go over some of these tools and to share with you, not to confuse you, but this is a lot of stuff that we have and that computers and people at Goldman Sachs and Morgan Stanley and all the big institutions are not hiring traders and analysts. They're hiring PhD rocket scientists to program algorithms. Now, I'm going to tell you right now, we could look at outside of the box programming, but it really comes down to 5 basic ideas. You could look at the correlated changes during certain times, what the market does if it moves above its average true range over the last 10 days, or if you just get down to the brass tacks, we have all 5 very simple inputs that we all have equal access to. It's the open, the high, the low, the close, and volume. I mean, really, there's that, and then there's time. How much has price changed over time? But those are a lot of variables to input, and that's what algorithmic criteria is based on. Now, all of these tools give us an edge. They do not guarantee success. I think there's a lot of issues at hand which include liquidity and news-driven surprises, like student body left goes long and a news surprise comes out. If anyone is surprised by an outcome in the French election, then for one, you're not paying attention to the news and you didn't know there was a French election. There's also a referendum in Turkey that gives the president more power that's coming out. There's also an election in South Korea that's coming up in May. So there's a lot of different elections, not just the one in France coming up. There's a lot at stake that may affect the emerging markets with this referendum vote in Turkey. There's also, what's been going on with all the publicity of North Korea. Well, there's a presidential election in South Korea that's coming up in May. So that there is some international events that are happening. I don't believe in black swans. If you guys, how many of you believe that in 2007 no one saw the housing crisis coming? Really, nobody saw the housing crisis. We just didn't know what hour it was going to implode. But I think everyone was not, I don't think we can call that a black swan. You might believe, and as I do, in what I call ugly ducklings. You knew the bad news was out there. The market just took time to be affected by it. There was like a delayed reaction. Major events are usually foreseen. They're either ignored or the market undergoes that delayed reaction. So what do we do to help guide us? Well, one is looking at seasonal analysis. You know, there is that phrase, sell in May and go away. Well, there's certain things that markets demonstrate and have these seasonal price patterns, and meaning they tend to make highs or lows near, keyword is near. It's not exact and it doesn't happen all the time, but near the same time period year after year. So we definitely see certain things that demonstrate that seasonal patterns, but the moves can either be muted or magnified, meaning you get a small move or you get a huge move. So muted or magnified, it depends on if there's economic turmoil, political events, or a new presidential administration, monetary and fiscal policy or stimulus changes, which is what we're trying to see come out of Washington right now. So let's take a gander at this, if you would, for a moment. This is the SPX. This is a seasonal chart. And I just wanted to see what is the relevance and show you what is the relevance of the sell in May and go away concept. Well, here we are, and probably right here in the cycle in mid-April, right? So generally speaking, in the S&Ps, we've had more times to rally from mid to late April into the first part of May. So it's never, no one ever said it's the 1st of May. It could be the 30th of May. This seasonality could shift to the left, it could shift to the right. But somewhere in May, we want to be paying attention for a market that has at least a tendency on average since history in the SPX to go down in the month of May. That's kind of compelling to look at. Now this is the Russell 2000, which was up today. But the Russell was up today, but it's down year to date. So it's not really up a big deal. But if you notice here, it tends to also peak out. So it's not just exclusive to the S&P 500. As well, the Russell 2000 has a tendency to peak out, something we need to be on guard for, right? So what kind of components don't behave bullishly this time of year? I thought it'd be interesting to just show some of the subsectors, just to give you an idea. Semiconductors. So if we look at semiconductors, they tend to peak out in, as you can see, this is April, that's May. So in mid-April, semis, NVIDIA, for example, AMD, Micron Technology, Microchip, Lam Research, LCRX, those are the stocks in the semi community that tend to peak out. And it's not just a seasonal shift, it's an annual high. They generally tend to make their annual high. Like the worst time of the year to get long semiconductors on average is this time of year. Does it work every single year? No, but on average it does. So we have to kind of use a combination of tools to see if maybe perhaps we're overbought and if the market's overstretched. So another one is healthcare, and that's really kind of an interesting topic since healthcare is on the chopping block, at least trying to get a new reformed Obamacare under the table. So we don't really know how that's going to play out, but looking at and that should be an X, not a VLV, sorry. XLV, Johnson & Johnson, Pfizer, Merck, Abbott Labs, UNH, Bristol Myers, Amgen, Lilly, Medtronic, which I think is getting bought out. But when you take a look at this, in about mid-May, folks, that's later in the time cycle, that's when you have another sector that tends to make an annual high over time. So there is a reasonable expectation to expect some turmoil down the road. Now, that's seasonality. And I wanted to cover a little bit about what we call relative strength comparative analysis. And that's like, do we take a look at a technique to compare individual stocks or sectors to the S&P 500? How is this information going to help me make money? It's real simple. If I see the Russell, not 200, but that's another typo, my bad, 2000. If the Russell 2000 is underperforming and the NASDAQ's over or outperforming, can I expect the NASDAQ to go down and the Russell to go up? Well, that would be something of a spread that we could look at, number one. And number two, it's something that we want to compare and look at one stock or sector to another. Typically, since the S&P 500 is the benchmark market, we're going to be looking at comparing one of the sectors, regional banks, the KRE, to the overall market, the S&P 500. So when we look at a chart, you can see in terms of percentage, they both kind of move up together and they both kind of move down together, but there are times when they diverge. And that divergence is when that starts to show divergence, it's starting to show ahead of time that the underlying product, in this case it's the KRE, is starting to show relative strength. It's outperforming the market. A strong market tends to get stronger, and that relative strength is kind of important. By the way, this is an indicator that we helped design on Genesis Financial, and basically it's just a spread ratio. As you can see here, it says spread ratio between the S&P 500 and the product that we're looking at. So I developed, and many of you are familiar with this, we've done past webinars, an indicator which helps me to define relative strength in terms of not just the market performance, but whether it's underperforming and its net changes, which is pretty cool. This is a stock a couple weeks back, Whole Foods. And many of you are familiar with this little pattern that we identified and published over 15 years ago called the high close doji. What's interesting is what we have happening here, this is Whole Foods, by the way. I mean, it looks a little bit more dramatic than it really is from 29 to 34, but it's certainly a nice little market upside move. This is the relative strength. This is almost the same kind of indicator, except for what it does is it helps us to define if a market is underperforming the S&P, it's below zero line, and as its stock starts to move up, it starts to show that it's getting positive performance. So relative strength is a very integral part of deciding what stock to get into and how to, keyword here, filter out bad trades. Filter out bad trades. The relative strength, or RS approach in general, adds value to an investment process. Now, in TradeStation, I have a radar screen that allows us to visualize and grade the relative strength, and it's color-coded to help identify performance. We have several different things that we look at. Lagging to weakening stage, and that's when the histogram bars turn red. Anyway, we'll get into this in just a second. In fact, I think I'll just jump right ahead because a picture speaks 1,000 words. All right. So basically, if a market is starting to go up, this is Jack in the Box, right? If a market's starting to go up and it looks great, do we buy the momentum? Do we buy the breakout? If its performance is starting to decline against the overall market, as you can see, it turns red. It goes to the zero line. The relative strength against the overall market started to decline. This was starting to show a relative weakening. And even when the market made and tested its highs, the relative strength was still negative. This would have been a bad choice to be a buyer of this market. Now, I'm going to do something that's probably not smart. I'm going to switch over and show you something here using Thinkorswim, and just to show you about relative strength. Here's Goldman Sachs. The same type of pattern. When we made a newer high, notice that the relative strength was making a weakening, or it was making a substantial divergence pattern. And then all of a sudden, it starts going negative. The relative strength in Goldman Sachs has been negative. One more. This is IBM. IBM, not really a surprise that it ended up lower today. Same kind of thing, was making a high, and all of a sudden, the relative strength, look at this. If I could draw a straight line, I would. The relative strength has done what? It changed at 182. It started to weaken. It wasn't a strong market environment. And now that IBM is down, and of course they had bad earnings, it's trading roughly around the 163. We'll be looking at IBM. There's a little gap down here in the market. I'm not sure we're getting to 157. There's older highs around the 160 area. When this relative strength starts to turn positive against the market and we get buy signals, that's when we'll have a better idea of when the market and we get buy signals. That's when we'll have a better idea of when to buy IBM. All right? So the relative strength does have a prominence and importance in our analysis in this market, without a doubt. So when we take a look at certain things, and I wanted to share you the same kind of concept with bearish divergence, it's the same type of pattern or condition of the market. When we start to see relative strength weaken in the market, stay away. That's the message. It's a tool that is helpful. Right now, Exxon. I know there's been a lot of talk about looking at the energy sector, and Exxon, one of the things that we've even been stalking, and I've been like waiting for a buy signal, but Exxon, same kind of condition. As the market starts to move down, when the relative strength is weakening and it's sub-zero line, before I start looking at saying I need to buy Exxon, first off, I would like the market to show some relative performance and some positivity in the market. And second off, I'd like to find a PPS buy signal eventually in that market. Let's take a quick look at Exxon together and say what's going on with this energy sector, right? So Exxon started to show a relative strength performance, and all of a sudden it's just weakening. It's not even in a buy signal. It's not even in a buy mode. It has a hard time breaking out. Let's take a look at the weekly higher degree time frame. This is probably one of the ugliest relative strength patterns that I've seen, and I don't want to get into the same kind of condition, but it definitely, unless we start to turn more positive in this market, rallies are going to be far and few between. Now that's just Exxon. Let's take a look at XOP, the energy select sector of oil and gas exploration. The weekly charts, relative strength-wise, and this is what's amazing, is because from a seasonal perspective, this is like the best time of the year to buy energy. Usually, seasonality kicks in for energy, and it shows strong performance this time of year, and we're not. Crude oil, by the way, let's take a look at crude oil, because this is a part of what we're facing going into this second quarter, which just started 18 days ago, right? If we take a look at crude oil prices, which we've seen a recovery, I mean, quite frankly, they were down in the 40s, we're back in the 50s. It had an uptrend, but a lot of the energy component stocks have not participated in this rally. There is a disconnect. That disconnect is not really giving a lot of confidence, especially because of the fact that we're not seeing that relative strength turn positive against the overall market. I think that when we start to see the energy component stocks turn positive relative to the S&P 500, that's when you're going to start to throw money and see the institutions throw money into that market. This is a tool that institutions are using, and I'm sure a lot of you are familiar with relative strength. I don't know if you've given, what I have found in recent months is that the correlations and the relative strength of the market has been something of more importance, and we're not seeing, I guess the thing I would like to see is we've seen, I guess, a stock picker's emporium here. This is not a market where you can buy a complete sector. It is a market where certain stocks do well and certain stocks in its same sector don't do well. And not all sectors have enjoyed this rally. Obviously, we look at retail. I don't have to mention retail apparel. But if this is the time of year where we start to see materials sell off, industrial sell off, we start to see all of these sectors start to sell off, combined with the fact that the strong stuff is still weak, that may allude to coming this May, a more meaningful sell in May and go away. So I'm tonight basically trying to share with you guys the tools that I'm using and what I'm looking for in the market, where I'm looking to help me time market turn points. And one of the things is this next topic. Besides looking at relative strength, it's a phenomenal timing tool along with our PPS indicator, but the market correlations. This is something that I think you probably say, yeah, I'm familiar with it, I hear it all the time. But there's certain things that we hear that in the past don't work. We have a disconnect with a lot of traditional or historic market correlations. Stocks go up, bonds go down, right? You've heard that one before. Crude oil goes up, stocks go up. Remember that one? Oh, as crude oil goes, so does the economy, and it's good for the stock market. When crude oil goes down, that's good for consumers. They're going to spend money. Do you remember that one? Crude oil would go down, gas prices would be cheaper, consumers would save money, and it would go into retail. Well, tell that to Macy's, because they didn't buy that story very well, right? We have market correlations. We have two ways of saying a market moves in tandem or has an inverse relationship. Now, this is kind of important because we've already talked about a delayed reaction, or otherwise known as lagging reactions. We have leading and lagging. Quite frankly, we've been using this in our day trading in two different markets that I'll share with you in just a second. So in market correlations, because everything's priced differently, you have to look at things in terms of percent changes. You can't compare the S&P 500 or the NASDAQ 100, the Qs, to gold or treasury bonds. You're not going to be able to look at these correlations, so they should be measured in terms of percentage. With computers and programs and software now, it really does make the job a whole heck of a lot easier than it did 15 or even 10 years ago or 20 years ago, for that matter. And I think market correlations will help us to determine return on capital, risk, and also position size. This is something that is the benefit of looking at correlations. Let me explain what I mean by that. First off, market correlations to consider. Time efficiency. How soon can I expect if one market goes up if it has an inverse relationship to another? So if I think that stocks go down, bonds might go up, is it an immediate reaction or is there a delayed reaction? What's the time efficiency in looking at that change in valuation? And it may help me to determine how and when to hedge. Last week we identified a very short-term trade was in the UVXY. And we had a great little trade, and if you're a TradeStation user, we did this, was it 2 weeks ago, on TradeStation Thursday, actually. So it was a nice little thing that we put out and a recommendation to buy, and we did this in our own little trading room because it was a short-term trade on UVXY, and I'll share that with you in just a minute. But it also, looking at market correlations, can help us to understand how long to make or lose money. And that's the key word, how long it's going to take us to make or lose money. And that's something that's very important. If I can maintain winners and cut losers, and I'm going to have losers, and I do have losers, and we try to minimize losses, but no doubt about it. get stopped out, that's okay. Generally, when I get stopped out of a trade, it was the right move to get stopped out, because if the market doesn't have that strong momentum and I'm on the wrong side of it, I need to get out immediately. It's kind of like this. You know, if the market, the S&Ps, when they crash, they used to go straight down. They wouldn't give you a chance to get in. If you get a sell signal and the market just sits there for 5, 10, 15 minutes and won't go down, that's generally a bad sign. How many people have noticed that, right? You get into a sell signal, the market gives you a sell signal and it goes down and it just stops, right? And you better have a stop in there, because the market's going to turn around and just hit you in the face if you don't have a stop. But I think another thing, and to tie in tonight's presentation, is that seasonal shifts in the market influence short-term trends. This is kind of an important element, because we have right now, we are faced with a seasonal shift in a lot of different sectors, as I've just illustrated, and there's others. Now, here's what I wanted to review about correlating markets. Many of you are familiar with this. Humor me just for a minute for those who aren't. This is a chart that compares over the last, not 1, but 12 years. 12 years of looking at trends. This is a weekly chart. You can see it right up here. And we have brown for crude oil, gold is yellow, NASDAQ 100 is blue, bonds green, euro currency, WU, we call it the WU, in Trade Navigator symbol is WU, and the E-mini S&Ps. So the WU is the opposite of the US dollar. So we have the E-mini S&P, we have the euro currency, bonds, NASDAQ, gold, and crude oil. So if you take a look, we would see an inverse relationship between bonds and stocks. So let's take a look at these two right here, green and black. Green and black. Well, that's not an inverse relationship. Green and black. And then finally, we have green going down and black going up. So that's kind of strange. We were under the impression that all the time we see a relationship where green goes down and black goes up. There's a time where the correlations don't match, right? So this is the NASDAQ 100, the NASDAQ's move over time. And this is the move in gold, and this is the move in bonds. And if you could take a look at the difference, we've seen gold go down and bonds go up. So we're looking at different correlations of different markets at different times, and you can see that they're not in sync, consistently in sync. And the reason is because of what we've already, believe it or not, covered. Changes in fiscal policy, monetary policy, changes in world events. So what is going on in the market right now? What can we sink our teeth into? Well, it's kind of ironic, but here is the same stuff. Crude, brown, gold, NASDAQ, bonds, euro, and E-mini S&Ps. Since on or about the election, okay, the S&P and the NASDAQ have been trading in tandem, but one has flatlined and one accelerated. Since that time, gold went down, bonds went down, and what happened? Crude oil went up, crude oil went down, and there is a slight resemblance now, believe it or not, between gold, crude oil. There's also a strong correlation between the green and the gold, meaning bonds go up, gold goes up. Bonds go down, gold goes down. Bonds go up, gold goes up. But notice, this is the point I want to make. Notice sometimes when bonds go up, gold really goes up. Bonds go down, gold goes down a little bit. Bonds go up a little bit, gold really goes up. Sometimes we see bonds go down more, gold goes a little, gold goes up. What's the point I'm trying to make is they do move in tandem together, but sometimes bonds move more than gold, and sometimes gold moves more than bonds. But they've been trading, gold and bonds have been trading almost identically in sync. Now it's not 100%, and this is a daily chart. So let's nail it down on an intraday basis. We went from a weekly to a daily. Now let's look at, holy moly, a daily chart, an intraday 60-minute chart. This is a 60-minute chart. The reason I'm bringing this to your attention is I want you to focus, if you can, see through the maze here. Gold and bonds. It's almost as if one of them leads by a few minutes more so than the other. Bonds go down, then a delayed reaction, then gold goes down. So that's kind of an important assessment right then and there. We are looking for a technical tool, and we are looking for an edge. If you're looking to make money, then understanding correlations, understanding relative strength, putting it all together may help you to identify. It depends on your style of trading. Day traders, whether you're swing trading or trading equities, there's something there for everyone. And I think if we start to see the turn in a market from a longer term perspective, and the market would be the S&P 500. So let's take a look. What I wanted to focus in on was the S&P 500, which is black. Okay. So if as we see gold go up, stocks go down. Gold goes up, stocks go down. Gold goes down, stocks go up. Gold goes up, stocks go down. Gold goes down, stocks go up. Gold went up, stocks go down. Do you see that correlation? It's inverse, but there's a strong correlation, and it's been going on since the election. What else has been going on since the election is this green and gold relationship. But notice the key here is it's not happening at precisely the same time. Even over here, bonds peaked out first, then gold went down. Bonds went down more than gold. So that is one of the things that I wanted to bring to your attention in tonight's session is what do we do going ahead into the second quarter? What tools should we be looking at? If you're not looking at correlations, one of the things from a day trading perspective we used to look at was if S&Ps go up, bonds generally go down. Today, S&Ps were down. We had a slight disconnect. Bonds exceeded their average true range by about 40%. What that means is in the last 10 days, a 10-day ATR, the bond market has had about a 1 and 8 tick range. Today, it had a 1 and 29 tick range. It expanded almost 40%. So where the S&Ps did not barely move, I mean, they were down 7 handles, something like that, the bond market accelerated to the upside. So one of two things are going to happen based on this correlation. Either the bond market is telling us something and the stock market's having a delayed reaction, or the bond market's getting ready to turn around. So looking at seasonal analysis, we could take an understanding that, by the way, this time of year, bonds actually do rally. So maybe this is a short-term temporary aberration in the bond market. But on the other side of the coin, we're looking at an equity market that perhaps might have a delayed reaction, and so therefore a downside selling may go away. So we're not quite there. Going forward over the next couple weeks, and as every hour goes by from now and after we finish together, folks, guess what? It's going to be May. And you might as well do your Christmas shopping because Christmas is right around the corner. I know that's blasphemy, but Christmas is right around the corner the way these years are going by. We haven't even gotten to the Kentucky Derby or maybe the Stanley Cup Cup playoffs, and I'm already talking to going holiday shopping. Wow. What I want to be focusing in on is these correlations, because they seem to have right now what's working. If you're a day trader, these are some pretty slick ideas that if you see bonds go up and all of a sudden bonds start to turn down and you have too high of a risk, maybe focus your attention to gold immediately. If you don't know how to trade gold, study up. It's not that hard. It's $100 per dollar move. Adjust your trade size accordingly. So if you get a delayed reaction, right, something to study, if you miss the trade in bonds or the risk is too great, maybe focus on a short position in gold if bonds start to sell off. Bonds and gold start to sell off, perhaps, by the way, based on recent, and this is recent data, if bonds and gold start to sell off, we might see bonds and gold start to sell off a short-term rally in the equity markets, and that's black. So that correlation to read through is kind of important, all right? So this is even nailing it down on a 3-minute basis. This is a 3-minute chart. So the gold chart and the bond chart. So bonds peak out and go, and so all of a sudden, here's the thing. Some days bonds will give you a nice trade, and other days gold gives you a better trade, right? So being correlated in two of like markets, just make sure that if you're long equities and you want to have a hedge, and if equities go down and you're long, perhaps you're going to get a rally in gold, because right now gold has been acting as a pretty significant play along with bonds. But I just wanted to share with you, if you're not aware of this right now, the euro currency, there isn't an exact correlation with the direction of the euro currency, the dollar, and of course bonds, right? And if you look at this crude oil chart, I mean, it's definitely not correlated to the markets. So if you look at the NASDAQ and the S&P 500, while one moves more than the other, and that's the separation, they move pretty close in tandem, right? So this kind of illustrates, if you are a trader, the need for not just diversification, but to be diversified and trading multiple markets at the same time. One, they don't all break at the same time. One can lead. They don't all go down in the same percentage terms. One might give a better movement, okay? And you may be able to trade more than one market, because guess what? If the bonds did break and they move sideways, then maybe you could get a better trade somewhere else. So by somewhere else, meaning gold. So with that said, it's a strong argument right now for looking at these intermarket relationships, the correlations, and again, as we've covered, a few little things that are the outlier of market analytics that have nothing really to do with the technical tools that most people would be using today, like indicators like stochastics and RSI. This correlation is my firm belief is being driven by algorithmic computer trading programs by institutions. And I'm seeing more and more of this being played out on a daily basis. And I think the key to success is, they always say diversification is the key to success. Well, it's having trades on non-correlated markets. So if you're a day trader, for example, or even a swing trader, it may behoove you, instead of having a huge position on short bonds, for example, to maybe spread that out a little bit and have a position in short bonds and short gold. That's my point. So instead of being one-sided trader, hey, I'm just long E-mini S&Ps, maybe you need to spread it out a little bit and be long S&Ps, or maybe have a position in bonds and gold at the same time, because maybe one day S&Ps don't move. Maybe it's gold, and so you'll make your money in gold. But if you're only in one market and heavily in that one market, you're not going to see the types of returns that the market is giving right now. There is a disconnect in the market. It's a disconnect between the dollar, bonds, gold, and of course crude oil. And so therefore, I'm telling you, in this environment and moving forward into the second quarter, this is the kind of style of trading I believe that everyone should be starting to examine. And it's not from being over leveraged one trade or one market. I think you need to be exposed a little bit and hedged out a little bit in multiple markets and understand that correlation. So that's kind of what I wanted to get to you, as well as understanding multiple market system. And I think independently, trading all markets is almost damn near impossible. As a day trader, you can't really physically enter an order, put your stop, put your profit target, trail your stop, and be in 5 markets all at the same time. That's more computer algorithmic programming. To have your entry, your stop, your profit target, and trailing stops, I mean, on a 5-minute basis, that's a lot of work. You need a system to do that. And you need trailing stops in case a runaway freight train occurs. If you're long the market and all of a sudden the market just keeps going up and up and up and up, you're going to want to scale out and trail a stop. And that's why they say let the winners run and run their course. And if you're in multiple markets that are correlated, what if you're long gold and you're long bonds, and bonds have a run, but gold that day has a bigger run, right? Yeah, it's nice to make money, but it's nice to participate in the markets that are moving the most. And obviously, cutting losers, objectively, that's objectively meaning don't get married to the trade. The system says get out, get out. That's end of story. Don't argue with it. I have multiple time frame analysis that we use, and then I use this theory of continuation patterns, and this multiple concepts in my scans, and I'm just going to share this with you because it has something to do with the UVXY that I talked about, I would share with you. This multiple time frame, if a daily or weekly chart is in a buy mode, right? So if the weekly is in a buy mode, and it pulls up and it has a several day pullback, I would be looking for a daily buy signal to go with the higher degree time frame trend. That works for swing trading as well, and basically it's the same thing that we were looking for the other day in UVXY. We had a daily buy signal in UVXY. We had a daily buy signal. And then rather than saying, hey, we might see a sell-off in equities, but there might be more advantage in this environment to see a pop in volatility, we had a daily buy with an increase in volume. Ironically, look at the seasonal trend. It goes up, right? Now, when that occurred on the daily, we were also in a 60-minute buy mode. And what we were looking for and what I put out to everybody was just simply look to buy a pullback around 1612, or better yet, look for a PPS buy signal. It was a great little trade, worked out perfectly, and this is what I'm referring to as multiple time frame analysis. If you have a strong trend or change in volume, so the price action's going down, the volume's going up, it's showing there is accumulation in the market. This is that tool, on balance volume, that I referred to earlier. When a market goes down and there's more volume and the direction of volume is going up, it is called what I consider as convergence, because the trend of price is going down and the trend of the indicator is going up, and the two lines are converging. It's bullish convergence. So you get a 60-minute buy, and the volume on the 60-minute is going up. So you have a short-term trend confirming the higher degree trend change. All we're looking to do is, if the market has this pullback, at some point you want to wait for a short-term buy. Now this just happened to come right at daily pivot support. It gave a 15-minute buy. We had a beautiful entry for the trade room, something we gave out at that trade station Thursday as well. Couldn't have happened any better. Look for a pullback and around that 16-12 area, or look for a 15-minute buy. Why did I say look for a 15-minute buy? Because in one day, the market went up 8%. It went up 8%. We felt that the market was going to see a pullback, and it did. It had a pullback. When do you buy? Do you catch the falling knife, or do you wait for the market to generate a buy and then go up with trend? We look for the market to go back up with trend. Here's another little systematic approach to the market that I think is going to help you if you put all these tools together that I use and I teach people how to use efficiently. Number one, if the direction of the trend is starting to change, not just in price, but in volume, okay? And in the short term, the market's going down. Is the volume direction going down, or is the volume direction still going up? So if you get a move in price that's going down and the short-term volume is going up, baby, they're not selling this thing. By the way, this trade ended up becoming even bigger, rallying well over the 21 handle. That's the UVXY. And this was since the 6th of April when we gave that out. So I'm just trying to give you guys ideas of how to trade more efficiently, number one, what tools are working, number two, and how you can apply to your own ideas. And instead of saying, I think the market's going to go down, use other compelling evidence of saying, you know what, we've got these other correlated, whether they're inverse or directly trading in tandem, like the gold and bonds and crude oil, which seems not to have any relationship right now with the equity markets overall. To a degree, crude oil has been kind of going up and down and hasn't really had that influence or leading or lagging indicator that it once used to have. But gold and bonds does, and it's been doing it for quite some time since the election. So the point is, if you can utilize some of those tools and saying, when the market, when is it going to turn bearish? When do we get bona fide sell signals? When the correlations also jive. And that is what I'm saying, that I think between the seasonality coming, the second quarter is a really interesting quarter ahead of the summer. Congress is going to take a little break. No fiscal policies are going to be changed. This selling may go away, could be a little interesting, or it could just die out. If we don't get major correlated changes in the market, it might be a surprise that if everyone's looking for a sell-off, then it probably won't come. We need to understand what tools out there are going to help give us guidance to that. And I think these are what we've introduced to you tonight is some of the tools that, at least right now, I think institutions without a doubt are using, and ways that you can improve your trading. Number one, when you do get a signal in the market, then look for a corresponding short term to go with it. So let's just pretend this is a weekly chart, and that's a daily chart, and that's a 60-minute chart. So even if you got a sell signal on a weekly basis, then you're going to be looking for confirmation of sell signals on a daily basis and on a 60-minute basis. So coming into the second quarter, and I'm sure we'll get together again and do another customer appreciation introduction and see how things are going. I generally do that about once a month and share with you trade ideas and introduce you to things. And also to say, if you're interested in learning more about my style, some people think it's slightly confusing. Some people think it's over their head. It really isn't. You need to learn this material, number one. Number two, this is an algorithmically changing world. It is definitely run by the computers. We are getting more and more computer-generated programming in the marketplace. It's not going away. And, if trading was easy, then everyone would be gazillionaires. And I think for individual traders, learning algorithmic programs, number one, is important. But number two, at least if you're going to do it on a discretionary basis, then have an idea about seasonality, sector analysis, and this correlation and relative strength factors, because those are very critical and have been very powerful and working in this environment. With that said, I'd like to just point out, even using a nice little indicator here, this is the UVXY, the same chart, the on-balance volume, my little volume histogram, a momentum indicator of looking when things turned positive in the marketplace, right? It turned positive. So looking at the buy signals, and you see a market that goes straight up, you got to anticipate you should see a pullback. Instead of buying a small pullback, wait for the trigger and then go with the trade. That's just to share with you the different platforms, the same setup, just different platform. Now, for those that said, yeah, that was a little rich, I didn't understand it, and I can appreciate it, I do want to give you a heads up. We are hosting a 3-day seminar in Las Vegas. If you haven't already heard of it, I think you would find, at the very least, this information. It's a 3-day seminar. If you want to learn more about what we're talking about and you feel that you might be able to make Las Vegas, what I would suggest is we have always room for people that want to come out to Las Vegas, and it's a fun time, but we also are going to help create an algorithmic system and go over how to develop that system, and part of why we're taking 3 days to do it. If you're interested in this particular 3-day seminar, simply go to our website at personsplanet.com, go to seminars, events, and then seminars, and then you will come down to this page right here, and you can learn more about it. So we are going to learn about a little bit more about what we've talked about as far as comparative relative strength, cycle analysis, market internals, and developing more algorithmic programming. So if you are interested in this, there are 2 ways that you should find out about it. Go to the website or simply call our office or email us. You can call the office, and the number is area code 561. What is my office number? 655-1881, I think it is. That would be an interesting number to find out. I don't call my own office. Isn't that embarrassing? If someone knows my own office number, would you post it in the room for me? I think it's, we'll find it here on Contact Us, or simply just go to the website and hit Contact Us. There's several ways to add the number. There's our office, 655. Yeah, I did know the number. Wow, amazing. Apart from my wife, which I got to tell you guys, Sunday, Mary, my wife Mary, many of you have met her through the years. Mary celebrated 30 years of putting up with my ass. 30 years of marriage. So if I forget my office phone number after 30 years of marriage, I'm due for forgetfulness. But anyway, this is our office. We always, have people come and show up if they want to come and visit us. More importantly, you can give us a call if you're interested in learning more about the seminar, or visit the website. So I wanted to say thank you all for attending tonight. I hope you found at least, if not the Holy Grail, because that was not what this was designed for. It was about looking at what's ahead coming into the second quarter. Besides earnings season, we have an understanding that there is reasonable expectations for the quote-unquote sell in May go away. No one ever said it was the 1st of May, though. But more importantly, there are some sectors or subsectors that definitely weigh in on not just having a seasonal high, but an annual high, meaning that's the high for the year. Semiconductors, it doesn't happen every year. Some years there's a muted move, some years there's a magnified move, but it's something we all need to pay attention to as career traders. And more importantly, looking at the relationship, which long-term correlations do not seem to always remain true. Long-term correlations, crude oil goes up, stocks go down, for example. or stocks go up, bonds go down, for example. Long-term correlations are out of sync right now, and we want to be paying attention to those correlations for further evidence of what the market's going to do. Using multiple time frame techniques to time entries a little bit better, these are the things that give you, the trader, the edge in the market in trading. This is a trader's market. This is not a buy and hold investment market right now. I'm sure many of you are already aware of that. There might be some better value coming down the pike, and something that I've been writing about is elevated PEs, but we've seen an orderly decline, letting air out of the tires, and things can change coming out of Washington in a snap of a finger. So with that said, it's really a market that's held hostage by a change of monetary policy tightening here domestically versus abroad, where there's still, such as Italy and in Europe, using quantitative easing, bond buying program with the European Central Bank, that is, Mario Draghi. So there's a differential in interest rates. It's kind of weird. There's still a negative real interest rate in Japan, for example. So we have a very diverse market environment between monetary policy here as well as abroad, let alone potential new fiscal. So there are a lot of changes and see it tides. The one thing that we can say that can stay true to us is by paying attention and focusing on what the markets are doing and telling us. And using correlations is something that can help us, and that's what I hope to strive to have shared with you tonight. So the key to success comes from not only the right education, but applying what you learned. And it is consistency over a period of time that one acquires confidence, and that consistency is important. And this is my favorite phrase that I've quoted. Losing trades will happen. It's all right to lose your shirts. Don't lose your pants, because that's where your wallet is. Just remember that. Losing money in the market is a part of the cost of doing business, and you will have losers. It's a matter of being consistent. And I think the techniques that I shared with you tonight going forward into 2Q is going to be important, and a lot of these that we covered tonight is what's going to be covered in Las Vegas. So if you guys could make it in Las Vegas, it'd be great. We already have a nice, incredible audience already that are coming out, so we have a great group of people, and I just wanted to bring it to your attention in case you weren't familiar. And yes, I will be presenting at the Money Show, the Las Vegas Money Show in Las Vegas that week as well. So with that said, I thank you all very much, and I hope you got something out of tonight's presentation. You guys be good, and we'll see you next time. Andy, thank you very much, man. You're a gentleman and a scholar. Thank you, George.